But we want to note one key difference between today and that March and December major lows, and that is the Fed. The Fed came out and was very accommodative around these two periods. But in this case, the Fed is intent on raising interest rates and quantitative tightening. Today is Wednesday, June 29th. It is 10 a.m. here on the East Coast, and the S&P over the last 2 days has been fairly weak. That is really quite a bit. Yesterday, we tested the 3950 area and sold off pretty hard down to 3800, which is what we tested this morning. Now, we had been calling for a rally after the large June monthly options expiration. That is this blue line right here. You can see us talking about this on the Market Huddle or with Tasty Trade, or if you just look at our videos that we posted here on our channel, you can see that we were looking for this OPEX bounce. And that bounce was a function of positioning. There was a lot of deep in the money put options in the S&P 500 as well as single stocks. And as those are closed or expired, we believe that dealers have to buy back short hedges, and that can create a rally. Now, into yesterday, we got that rally. We got a roughly 7% rally. We're giving a little bit of that back. But our target date for the rally to end was tomorrow, June 30th. And that has to do with this JP Morgan roll, wherein there's a big put spread that's going to expire. Now, we dig into the mechanics of this here with the June OPEX video that we did with our friend Imran. But essentially, what the deal is that there's a JP Morgan fund that now has on this position that they are long this put, that's the 4285 put that expires tomorrow, and they are short this 3620 put. Now, the dealer is going to be on the other side of that, obviously. So in theory, the dealers are long this 3620 put, which means that as the market goes down, that position will make them some money, essentially. And so that allows them to provide some liquidity to the market, right? They're making money as the market goes down. They can maybe offer more liquidity. And in general, we think that's supportive of the market. Now, if you compare this position to what happened back in the March monthly options expiration, we got a very similar thing, right? The rally started a couple days before due to some very positive FOMC statements, but we got this big rally around March monthly options expiration. The market drifted up into the quarterly expiration. This is where the JP Morgan position expired and was rolled, and you can see we traded lower after that. We had mapped out for our subscribers a very similar trajectory here, and you can see how much this looks like, this period looks like what happened back in March. So let's show you here what that JP Morgan position actually looks like. I'm using Thinkorswim, but if you just look at your brokerage platform, you can see that there are 42,000 puts that are now deep in the money here at 4285, and that is offset again against this 3620 position that you can see here. So these positions are going to be rolled. JP Morgan will sell a 3 to 5% out of the money call and buy a new 3 to 5% out of the money put spread. What that essentially means is that this line here is going to be pushed lower, right? That long strike, the strike that dealers are long is going to be pushed lower, and that's why we think that the market can trade off. Now, another thing that we mentioned in our subscriber note, this is our subscriber note here. Again, in the description, you can get a free 7-day trial of this daily note. What you see here is our delta tilt indicator. What this measures is the ratio of put deltas relative to call deltas, and you can see that we are pegged down near lows that were seen in March of 2020 as well as December of 2020. Now, typically what happens in a lot of these scenarios is when big put positions expire, that means that the market can rally because not only are puts being closed, but calls are being purchased. What's happening here is that there are not a lot of calls being purchased. Traders are maintaining put positions, they're maintaining hedges, but they are not really trying to play the upside. Now, what happens is we categorize these rallies, and you can see at the top of our note, this is our theme here. We categorize the rallies that are now taking place as short covering. Now, why do we do that? Well, if dealers have to buy back shorts relative to puts, as those puts move to zero as the market rallies, the dealer short covering will tail off as well, right? Because the puts are moving to zero. I don't need to keep buying back futures to hedge something that's worthless. However, if calls are positioned in the market as the market rallies, then we have calls gaining in value, which means in theory that dealers that have to buy more and more shares of stock, and that can really extend rallies or keep them going. We're not getting that position. We're not getting that function taking place as we described in our subscriber note. The other thing to show here is our gamma tilt indicator. This just looks at put gamma relative to call gamma. So this shows a little bit more of at the money positions. And you can see that this indicator is pegged down near the bottom as well, suggesting that most of the positions that we have on now around where the market is currently trading are put positions. This is because gamma is highest for at the money options. You can see again that this is close to March of 2020 and December of 2018. Now, we don't cover macro here, but we want to note one key difference between today and that March and December major lows, and that is the Fed. The Fed came out and was very accommodative around these two periods where, yes, there was an options expiration that shifts the market to a favorable stance. But in this case, the Fed is intent on raising interest rates and quantitative tightening, which is in general not market supportive. So yes, we did get the OPEX bounce that we were looking for, but we have been talking about the subscribers that we think that into July we're going to get lower lows as a function of the fact that this put fuel, the fuel for a rally, is now gone. We're going to lose this supportive leg of the JP Morgan trade, the 3620 area. That's going to be rolled lower. And so from our positioning standpoint, there's no reason for the market to be supported here. And from a fiscal monetary standpoint, one could argue that there is not a whole lot for the support of the market either. So if you enjoyed this video, please give us a like and subscribe. If you have any questions, please put them in the description below. And again, please click the free 7-day trial that is available in the description.